Hi, this is Randy Finney with the Right Side of the Chart, and today's Friday, June 10th. I'm starting this video just after 10 o'clock Eastern Time, so the first half hour of trading is now under our belt. A lot of fireworks going on in the markets today, and quite a bit. More importantly, not just the fact that we have a first big down day in a while. Nothing huge. We're down. Here's the SPY down about 0.9%, but more so, there's some technical developments worth noting today, and that's why I wanted to do this in video format. Try to touch on everything. Keep this as brief as possible to get it out to you guys. That's to help you really formulate your trading plan going into the weekend here. All right, we're going to start out with just a quick review. This is a 5-minute chart of the SPY. In the trading room today, I mentioned, and I sort of alluded to this on the update on the front page today. The charts right now are what I use a term that I've made up. I call it the charts are stacked. And what that means by being stacked, it's like a domino effect when you have either bullish or in this case, bearish chart patterns that align all the way out from the shortest term intraday charts. In this case, I started focusing on the 5-minute chart. The other day in an update, I touched on the 60 minutes and the daily charts as well. And point being that if these 5-minute charts play out, which they did, we had the breakdown of the wedge, pushed a little higher, another breakdown. You can see just wedging, and then today, boom, a big powerful gap. This has a lot of bearish implications. If they can't run this back up above, I mentioned before, 210.70 was a key level I was looking at, and I did have this 210.50 just below, and that's where we opened. We fought it. They fought it for a little bit at the open, but they couldn't hold it, and we fell below. Again, now the significance at this point, the 5-minute charts mean very little. I don't see any bullish developments. So now we move out to the longer term time frame. So we look at a 15-minute chart. In fact, I mentioned the 60-minute charts. This 5-minute chart pattern, if you look at the trend line up here, that triggered at the point when I started posting those 5-minute setups. The 60-minute charts didn't have any negative divergence in place, but they did have potential divergence. The MACD was lagging. So as I mentioned, being that the 5-minute charts triggered, that has led to the 60-minute charts now confirming this divergence. You can see here the negative divergence is now confirmed via bearish crossover on the MACD. The RSI clearly rolling over. You see an additional peak on that 1333 trend indicator. So right now we have bearish technicals in place on the 60-minute charts due to those 5-minute charts breaking down. I mentioned, I believe it might have been in the trading room, either that or on the front page recently. 109.40 was a pretty key level I was watching on the Qs. I didn't update the Qs on those 5-minute charts because the Qs, if you notice, the QQQ didn't go anywhere really for about 3 weeks, going back to, I'll put the crosshairs here, that's the end of May right there, May 31st. You can see the Qs were flat. They were trading within this gap. There was that gap from back in late April, and they tried to punch above it but couldn't hold it. So they were in a sideways trading range from May 31st, while the SPY, if you look and do the crosshairs here, same time period is right there. The SPY and the IWM, especially IWM, had a rip. They moved up. They consolidated, broke out to new highs, or at least not all-time highs, but the previous reaction highs. And so that's what I was watching, especially the IWM. I was watching the strength in the IWM. I mentioned yesterday, this, I think, has the most meat on the bone. Some crazy souped up rally in the small cap stocks, getting way ahead of themselves, and they're paying for it now. You can see they're down 1.33, so almost a 50% increase over the drop in the SPY. As normally to be expected. Small caps are higher beta index against the SPY, meaning they go up more typically when things are going up, and they tend to fall more when things are going down. So, but they've also gotten really ahead of themselves, and you can see that the charts now are really firming up. These divergences, like I say, nothing is 100% in trading, but much more often than not, when you have clean 60-minute divergence, by clean I mean separation, you have a peak, pullback, a trough, and then another peak, lower peak. That's negative divergence. I won't go into too much of that. You guys know what divergence is now. That's I talk about it every day. But like I said, clean divergences across the board, and those divergences more often than not play out for tradable trends, especially. Keep in mind the divergences or the scope of the move is commensurate with the time frame. When you're looking at 5-minute charts, bullish or bearish divergence is good for either a day trade or maybe a 1, 2, 3 day swing trade. You get out to the 60-minute charts, and those divergences, such as this last positive divergence here, was good for that was back in May 19th and up through the 8th. And that is how many days? 20 days. So 3-week rally there. And you can see about comparable with the previous, negative divergence. So now we have that divergent high. We have a trend line break. And this is what I'm seeing a lot of these, not just divergence, but trend line breaks. And as we go out to the longer term time frames, this is where it gets really important here. And on that theme of the charts being stacked, we now have this divergent high. I did a pretty comprehensive update, a video update on the IWM the other day. Mentioned this breakdown. I've seen this before, and I mentioned seeing it here. You have a very clean, a steep rising wedge, a breakdown, and then this ramp. That to me is just a short clearing move, and these tend to lead to pretty powerful corrections once you have that. It's not healthy to clear out short interest in the market. As much as shorts are ostracized and demonized and from long side only traders, they serve their purpose in the market. And when you clear out a lot of the short interest, what you're doing is you're clearing out a lot of guaranteed buyers. In fact, shorts are the only guaranteed buyers in the market. What I mean by that, a long side only trader, they're either in the market, they're long, or they're out in cash. And the market can fall to any point. They don't have to step in buy. Shorts are short a stock, meaning they must at some point in time cover that stock. So they are an actual, a supply in the market, and they usually cover, on pullbacks to support, and that helps the market rally, in a healthy uptrend when you have short covering on when the targets are hit. So again, I haven't pulled the numbers. The problem with short interest, the data's lags so much. It can be 3 weeks or more behind by the time you get it. So that's just my read on the chart again, that I think a lot of short interest has been cleared out, which opens the door for a pretty swift move down. You saw it happen here. The wedge breakdown, that unnatural rip higher to new highs. Call it unnatural, whatever you want, but the most important thing, as I made the case before, the divergences were extended. Now, if they were burned through, in other words, if MACD made higher highs, negated that whole bearish setup, then we might not have had that. But in this case, that additional high was just a marginal new high, just as this one was, another new high after the previous high. Kept this divergence in place. And let's look at the SPY, because there's a broad market. Now you can see this divergence very clear on the SPY. You see the MACD curling over, and as I always say, this is still potential divergence in my book. It'll be confirmed when the MACD makes a bearish crossover, which is very close. You can see the line starting to pinch, but we're not there yet. And more importantly, and the point for doing this video, we're now at a very critical level. We're slightly below it. And what I'm referring to is this downtrend line. This is our primary, we can't call it a bear market yet because the SPY hasn't fallen 20%, but we can certainly call it a downtrend. As I've pointed out, the market peaked back in May of last year and has had numerous reactions, 2, 3, almost 4, 5. We did have reactions there. There was, we hit it, pulled back, took a little while. We punched above it. So as I mentioned before, my expectation, or what I was on the lookout for, is a bull trap scenario. A bull trap is a false breakout. So we did have a breakout. When it occurred, I pointed out, as others did, there was no volume behind it. And as I've always stated that breakouts that occur on average or especially below average volume are much, much more prone to fail than breakouts that occur on above average volume. Above average being 1.5 times the average volume. So we didn't have the volume confirming that breakout. And as of now, as I do this video, we're trading below that trend line. Daily chart, all that matters to me is how we close. So, I'm not getting excited yet. Being bearish and being still net short. I'm not getting excited, and I'm not adding yet to the shorts. We'll see what happens here. The day is young, and there's been many stick saves in this market. Oh goodness, for many years now. So anyway, something to watch. So here's what you're watching for. A close, especially a solid close, maybe a follow through on the downside. And if so, you should see some impulsive selling. If we whip back down, we come back up, come through there, that hampers the bearish case. You want to see impulsive selling. If my read on the charts are correct, this was just a lot of a short squeeze here. And I'm seeing, pointed out a lot of distribution on the NASDAQ 100 lately, some of the key stocks. And I think that's the theme lately. We've just seen institutional distribution on this most recent push up. But again, work to be done, so let's just wait and see what happens. Let's take a look real quick at the IWM. I already did that. The IWM we broke down, as I mentioned in the video just a few days ago. On the IWM, our sell signal would come on a break of that trend line, which we actually had yesterday. So there was your sell signal, a clear break and close below the trend line, and this is what happens. This is impulsive selling. This is what happens when they ramp a market up. Whatever powers that be did it, that's what happened. You can see that rip up, but the divergences here, just as all these other divergences in the past. And this again speaks to, you can just put your crosshairs, replicate this on your own chart. There's bullish divergence, you see the rally. There's negative divergence, and I have not omitted a single divergence on here. And if you see that, just let me know in the trading room. But typically the more powerful, the longer the divergence is, the bigger the fall. Smaller the divergence is, the less the fall. We had a pretty sharp sell-off there after that divergent high, so doesn't always hold true, but that tends to play out. So this one has a this is a pretty big divergence. That's about an equal high in the MACD. I'm sorry, the RSI, and close to an equal high in the MACD, but that's negative divergence because prices are making a higher high while the indicators are not doing the same. So that's IWM, and I already showed you in SPY, and I think the Qs were a little different. Okay, here's the Qs. This is a busy chart, very busy, showing all the divergences in the past, the rallies. We don't have negative divergence this time around, but then again, the Qs are still, we don't even need it. The Qs, as I pointed out, this was a leading index throughout the entire bull market off the 2009 lows, and this index has been severely lagging. And that, to me, like I pointed out, is a red flag. SPY was just within basis points or percentage point or two of I think about 1% of making a new all-time high, yet here you are with the leading index well off its highs and clearly struggling with its downtrend line. I'll show it to you on a clear board. So you can see the downtrend line off the highs. And the Qs rolled up, tried to punch above it, and it's turned back down and failed. And so that keeps the downtrend alive for now. But again, we need to see a little more follow-up, and there's definitely some support levels on the way down, so just something to watch. Something else worth noting is crude. This is CL, the crude futures. And as I mentioned yesterday, I believe this might have been put up only in the trading room. 49.90 is a level that I'm watching. Schooner has a good pulse on oil too. He's also watching that level. You can see the trend line breaks here going back. You have these uptrend lines. This one was a wedge, a breakdown. You had a little push higher, another wedge trend line break. And this was the most recent trend line break. And now this level is more significant when you look at a daily chart. I'm just looking at zeroing in here on a 60-minute chart, but that, call it 50-ish level. I like 49.90 to be safe, at least on the crude futures, and we're just below it. Nothing major yet, but as Schooner had pointed out, the correlation has been very tight between crude oil and the stock market. So let's keep an eye on both. And one may, I don't think there's really you can't call one. I don't think any one has leading properties. In other words, they tend to move in tandem lately. So, but if you see crude breaking down and you see the market breaking down, if they can't regain these levels today, that tells me, maybe add a little short exposure into the weekend. However, if one regains support, let's say crude rallies up here, one or two of the broad markets rally back up, or broad diversified indexes, I should say, like the SPY or IWM, if they rally it back up above some of these significant support levels that were broken today, then that would give me pause. And, anytime you go into a weekend, you have 2 extra days of overnight risk. No reason to really, as a rule, I usually don't add positions right before the weekend unless I really suspect something big, a big gap up or big gap down on Monday. And again, I'll do an update before the close today. Okay, I guess I'll wrap it up with the mining stocks. D. Patel in the trading room had asked about if I noted any divergences or anything on the miners. There is, I've already given you my take on the miners. We had but they fell short. We caught, hit the first 2 out of my 3 targets, pullback targets on GDX, fell just shy of the third, and then reversed. And I pointed out one potential scenario would be that this correction here recently was a bull flag pattern. It's not drawn out on this chart. I already drew it out. You can just see it right there. And we have, so far the price action has been typical of a breakout. You had very impulsive buying so far. So that's the bullish case. I'll tell you, I still lean towards more downside. You just can't short them here, especially today. I'm looking, the dollar's trading up pretty nicely. Yet gold is rallying, miners are rallying, and that shows it's a combination of a flight to safety into gold, out of equities. But I want to point out that I'm certainly not buying into this rally, and I do still lean towards more downside. Similar to the equity markets, what I just pointed out, a wedge breakdown and then a ramp up. That's what I'm seeing here. Should the miners turn down soon, now they can go turn down right here today. They can go up a little higher, but the point being is that we have double or consecutive negative divergences in place. In fact, let me take that one away. Let's just extend this trend line here. You can see that. So there's quite a bit of room to go. And until we take out that previous reaction high in the RSI and look down here in the MACD is severely lagging. However, the MACD is pointing up. It just crossed over. It can turn down quick if prices reverse. The miners can move fast. But my guess, so if let's just say we give it a little room, another, I don't know, day or so, a few days, might even be able to go another week before taking out these divergences. I wanted to point that out, that we still have negative divergence in place, in fact double divergence, and it's very possible, in fact it's my preferred scenario. Hard to short it right now, but that is what I'm thinking. I'm looking for some types of reversal here, something, maybe a bearish candlestick pattern, some reversal pattern. I'll take a look at the 60-minute charts in a minute. I don't think I'll do it in this video. I want to wrap this one up. Just wanted to point that out, that excuse me, that there's certainly the possibility that this little move here was just a short clearing, and a lot of people wanted to get into the miners. A ton of people that missed the initial move up wanted to position. I'm sure institutions and individuals alike. So I'm sure there was some natural buying there. But my guess, again, best guess right now, hard to bet it with the strength, especially today with the dollar being up and gold shrugging that off. But I think we get another move down, and I think we'll hit that 2145 pullback target ultimately in GDX. Something worth noting is the recent correction. Was not even it didn't even hit the 38 fib. Well, there we go from the previous high. We didn't even come down to the 38.2 fib, and that's unusual. This has been quite the rally, and so far this is all we've had is a correction of, what was that, like the 2023 whatever. What's the other fib on there? 23.6. Yeah, we just took out the 23.6 fib, which is really the minimum. So again, something to note, and we'll just have to monitor that. I'll update anything I see on GDX and the miners on the site soon. Okay, if you have any questions, drop me a line in the trading room or via private message. And again, I'll do an update today before the markets close. This has been Randy Finney with Right Side of the Chart. And if you like the video or any of the videos, give a thumbs up on YouTube. Appreciate it. Thanks.